Nice to see you again, and thanks for joining. Brad, it's so important for me to get some insight from you in the process of fundraising. I mean, I speak to entrepreneurs on a regular basis, and they often have a variety of different questions when it comes to how they should go about fundraising. Okay, so if there were to be a roadmap that could help them, I really do think that that's the strategy they would want to adopt when they look to raise capital for their company. Now, if you would break down the steps in a roadmap, and let's say there's 9 steps, and we start with the educational stage, how important do you think it is for a founder, a CEO of a startup to educate themselves on the basics of venture finance?
I think it's critical. And I think of venture finance as if you were in a college level program, there's 100, 200, 300, 400, there's graduate levels. If you don't have the 100 level, the foundational knowledge of the key building blocks, it's pretty hard to advance.
What I find all the time is I often speak with customers who buy the Venture Finance Masterclass. And the basic masterclass covers the foundational knowledge they need to know. But what's always interesting to me is that not many entrepreneurs are even aware of the number of different funding sources available to them.
Yeah.
What do you think about that, Brad?
Well, maybe they just they haven't studied it. They think, oh, I read TechCrunch or I read Medium, and that's all great. I mean, there's a ton of information on the internet, and there's a lot of stuff where they try to break everything down into, top 5 this or top 10 that, and it's a 3-minute read. My experience is it's pretty difficult to master the foundational knowledge in 10 minutes.
Okay.
And so what we did with the master classes, we're attempting to enable people to learn at their own pace the variety of different funding sources. And why is that important?
Right.
Because honestly, even though everybody talks about venture capital, honestly, less than 0.3% of all companies in the United States, which is one of the major venture capital markets, actually are funded by venture firms.
I see.
So what about the other 99.7%?
Okay.
They get funding, right?
Right.
They get funding in a variety of sources. And you need to know all the different buckets and places and strategies to get access to the funding.
I often put myself in a place of some of the CEOs and founders that I speak with. And if they've never raised capital before, there's going to be a massive knowledge gap on how that process works. And one of the things that has become obvious, more prominent to me now, is that a lot of them have not engaged with an investor before. So they have no idea how to do the deal or even to negotiate the terms. Mm-hmm. So could you provide some insight into why that's really important to educate yourself on how that looks?
I guess if you're playing chess and the other guy has played chess many years and this is your first time, you probably won't win. I mean, it's possible, but usually not. That's not the way to bet anyway. So the goal would be to educate yourself on the rules of the game. What are the strategies? What are the key motivations for the other side? I mean, it's a transaction, and both parties, enter into it willingly and knowingly,
Right.
usually.
Yeah.
And so the key would be to just educate. Why are they doing it? What is it that they want? What is it they need? And then you say, okay, what is it that we want? What is it that we need? And obviously, depending on the different profile of the source of capital, which could be an individual, it could be an institution, it could be, who knows? It could be a foundation, it could be a company. What is their motivation? And so it's important to make sure, in order to help you get the best deal for you, you need to understand what you might need to give them. Right. And frankly, you might not need to give them the stuff that you would want.
Okay.
Because you're not them. We go through this and we try to make a lot of this information available. We have a YouTube channel where we go through a lot of different scenarios and different profiles and different examples that could be relevant. You know, there's lots of stories in there, and I'm a bit of a storyteller. If you talk to my kids, they would say maybe I have too many. But maybe a good example of this is, I think it's generally true that for most entrepreneurs, if they could get away with not raising money or get away with not giving away equity
Yeah.
to third parties, they would. And there's a lot of different reasons why people don't want to give up equity. One is, frankly, just control.
Yeah.
Control that they're going to lose the creative control, or control that they might lose some financial control. But maybe there's ways that you can get access to financing that you frankly just haven't thought of, like revenue-based financing.
Okay.
And what are the risks? Because honestly, I've seen some companies that access revenue-based financing, and it sounds pretty good until it doesn't.
Right.
So without getting into any dirty laundry, I would just say that, you know, anytime you're asking for capital, even if it's a grant, even if it's free money, there's usually some string attached, and it's important that you understand what that is.
One thing that's always intrigued me when I speak to some business owners, some entrepreneurs that have never raised capital before, is I think they have this impression that because they have a business that's profitable, which should equal then getting an investment, right? And there's a whole process involved that they have no knowledge of or experience of. So I would like to know from you, Brad, do you think it's a naivety? Anyone who owns a profitable business, does that necessarily mean that you will be successful in raising funds?
Absolutely not.
Right.
No, because there's a lot of businesses that are profitable that nobody would ever buy. Why? They're profitable because you have a successful entrepreneur. And a good example would be a plumber. If you're a really, really talented plumber, you can make a lot of money. You can be highly profitable. At the end of the day, couldn't you successfully sell your plumbing business? Maybe. Who's going to buy it? So whoever buys your plumbing business better also be a pretty good plumber.
Right.
Okay. And if they are a good plumber, you know, like any other tradesman, they can probably take advantage of the client base, but they're not going to pay a huge premium for that, right?
Right.
So there's lots of businesses out there that generate profits that frankly aren't that attractive to a buyer, to a potential buyer. But one of the key things what is an investor looking for? They're looking for a return on investment.
Yeah.
So investment can come in all sorts of shapes and sizes. It doesn't have to be equity. It could be debt. It could be convertible securities. It could be a revenue share. You know, but whatever it is, it needs to offer some kind of a return. There's no reason, unless of course it's just pure philanthropy.
Yeah.
Uncle Joe loves you. He's, you know, hey, here's $100,000. Go to town. I mean, it happens.
Yeah.
I've seen it happen, and I've seen it happen on bigger scales than that. But it's pretty rare, and it's not a route I'd recommend. Now, another example that I've seen is where people enter into the transaction for reasons that may not be financial, which is even trickier. So, for example, there was somebody who came to us because they had an investor who was hot to trot, willing to make a substantial investment in a going concern. It's a nice business. The prospective investor was coming from a country that is on the embargoed nations list of many Western countries.
Right.
No reason to believe that they were a bad person or anything like that. But the primary objective of the investment appeared to be an owner of a company in a new jurisdiction that would entitle them to get some kind of residency permit. And there's nothing wrong with that necessarily. The question that was presented was, okay, if I do this, are there any downstream consequences? And the answer is maybe, probably.
Yeah.
Because if you do want to ultimately take this company, which has the potential, if it chooses, to raise substantial amounts of equity from traditional, say, venture capital firms, if that money's coming from, say, the United States or the UK, frankly, EU, the ownership structure would be compromised.
Right.
All right, so given that the primary objective of the money wasn't really to make an investment, it also seemed like it was potentially dead equity.
Right.
It wasn't, they weren't really going to add any value, potentially destroy long-term value. So it seemed like a pretty good deal. It seemed almost too good to be true, in fact.
Yeah.
But I think the entrepreneur made the right choice and doesn't regret it and said, not a good fit.
Right. So again, I speak to a lot of our masterclass customers, and I mean, obviously they purchase the masterclass to gain an education on the process. But I often have a call with them, and some of the questions they ask me is how to access or find ideal investors for their business.
But I do love the Dragon's Den, and
Right.
I think in the US they call it the Shark Tank.
Yeah. So in the US you have Shark Tank.
Shark Tank.
In the UK we have Dragon's Den.
Right.
And so many people watch that.
Right. Yeah.
Not even not all of them are entrepreneurs.
No,
right?
no,
Or
it's a TV show.
founders.
It's
a
a
TV
good
show.
Yeah.
But isn't it interesting
Yeah.
that in that show you often have the dragons or the investors who will give feedback.
Yeah.
And quite often it's the entrepreneurs don't know their numbers. They haven't prepared their presentation properly. They don't know their market. They haven't done research. They haven't done a pattern. What I get when I speak to our basic masterclass clients is they have an idea or they have a minimal viable product that they want to develop, but yet they've contacted a VC or private equity firm and they said, hey, I've got this great idea, fund me.
Yeah.
Right? And I think, whoa, you've gone straight to a VC, like there are other funding sources. So, I mean, in your own experience, Brad, what insight could you provide for an early stage, CEO, founder of a startup that are just starting out when it comes to identifying the right sources of funding?
Well, again, I am a firm believer that you need to educate yourself, first and foremost. And be realistic. If you're at a particular stage that makes it highly unlikely that a particular source of capital would be able to get it approved, then you're just wasting your time and their time, and you're destroying credibility. You're spinning your wheels. It's not time well spent. So the various types of investors, some of which are publicly available, and they express, this is what we do. These are our deal parameters, blah, blah, blah. That's great. But honestly, a lot of the sources of capital don't have a website. They don't publish that. So then you just sort of have to say, okay, given where I'm at, what is the highest and best use of my time, and how can I maximize the probability that I get access to the capital? Now, the easiest source of capital is your own personal savings. Right? And if you don't personally invest your own savings and time and energy, honestly, nobody else is going to invest.
Okay.
I mean, that's the fact. I mean, I've seen entrepreneurs with great ideas. They're still working at a high-paid job somewhere, and they're like, as soon as I get somebody to invest, I'm going to quit my job.
Right.
Okay, how's that working out for you? I mean, seriously. And so you do at some point, you got to take the plunge first, right?
Yeah.
If you take the plunge and people know, okay, this is real. I mean, somebody has skin in the game. They've taken a risk. It'll attract other people to say, look, this is somebody that I'm willing to join. And that can come from friends, family. People talk about the fool, who is the fool?
Yeah.
And I know it's some people, I get some flack sometimes talking about the fools, but it's a correct term. If you're throwing money at a deal and you don't like the person, so friends and family. Friends are about, hey, I'm supporting you in part because you're my friend.
Right.
right? So it's like, hey, I like you, I'm gonna, and I respect you, but let's be honest, you're my friend.
Friend, yeah.
Okay, honestly, I query whether that's a good source of capital. It's a good way to lose some friends.
Yeah.
Okay, what about family? Okay, family, presumably if they're going to give you money, they probably love you. It's probably beyond the like. If your family doesn't love you, they're probably not going to give you the money.
Right.
Okay, that's my experience. But even if they do love you, they still might not give you the money. Yeah, but sometimes they do. They're like, hey, look, we have resources. We're going to make those available, and we're going to hope for the best.
Right.
You know, and that's great. You know, so now you got friends and family. Now the fools are like, this is somebody who usually it's in a bubble economy. You know, they're like, geez, I got to get access to this startup. I don't have very good deal flow, and I met a guy. He seemed cool, and then, you know, in a state of euphoria or poor judgment, probably both, they just invest. Usually they live to regret that, right? So friends, family, and fools. You know, it's possible that, you know, a friend or a family member can convince their friend to invest, which again, I would say, if it turns out poorly, is a good way to lose some friends. Okay, and I know what I'm talking about here. So there's that source of capital, your personal capital. That's your best source of capital. After that, there's a whole bunch of other resources. You know, it depends on what country you're in, or what community, what networks you belong to. But that's where you're going to tap it. And I guess the biggest issue when you say, what's the advice? The advice is to be realistic. Is your venture potentially disruptive that could create a huge new market? Could it change the world? That's a big deal. Okay, but those don't come along very often. Or is really what you're doing is, I got a minor incremental improvement on an existing way of doing things. Or worse yet, here's my strategy. I'm going to provide a same quality service, but I'm going to charge less.
Okay.
A lot of people do that. I'm like, how's that a good idea? Really? I mean, if you've got a better way to deliver the same quality at a lower price point because you've innovated,
Yeah.
great, charge less. Lots of companies have done that. But if all you're doing is the same thing and you're just charging less, I'm going to predict that you'll go out of business.
Pretty
Okay.
soon.
So that's kind of what I learned. And we talk to people all the time. And you got to start somewhere. I think the other thing that's key is you just got to get out of bed and just do it. And you know, every day you get a little bit smarter. And if you just keep working the problem and talking to the right people and trying to learn from your mistakes and not make the same mistake, hopefully more than once, or definitely not more than 2 or 3 times.
Yeah.
That's how these companies get off the ground. That's what I've learned.
No, that's very insightful. Thank you, Brad. And I think it's just from a logical and rational perspective. I think if you're getting into anything that you don't have experience or knowledge about, it does make sense to educate yourself. Even if it's something that seems as obvious as raising funds from investors, there is a process involved, and it's certainly worthwhile educating yourself.
For sure.
Great. So Brad, we've covered the educational stage. So we've looked at understanding the fundamentals of venture finance. We've also looked at how to identify the ideal sources of funding. So Brad, when it comes to the principal deal structure, you know, how to do deals with investors, is it really as simple as we see on Dragon's Den and Shark Tank, where you have the entrepreneur that says, hey, this is my business and I want to raise X amount of money and I will give up X amount of equity? Is it really that simple?
I love those shows. I really do. They make great TV. And I know several people that have even been on those shows. And, you know, the shows are typically aired about 6 months after the thing happens. So I can say both what I think happens, but also what I know to have happened. And the short answer is no, it's never that simple, right? I mean, when you say, I'll give you whatever, $1 million for 40% of your business, what does that even mean? Is it a common stock deal? Is it a preferred stock deal? Is it convertible debt? Or in the Silicon Valley, these safe notes are really popular.
Okay.
Okay, so the deal terms matter. Is there any board of director representation? Sometimes you'll see that. Oh, I'm going to give you this, and I want a seat on your board. Well, is it one seat on a 3-person board?
Okay.
Or is it one seat on a 5-person board? What about the protected provisions? Are you free to just take the money and go to Hawaii?
Right.
Or is there some limitations? Like, okay, we're going to give you the money, but these are the things that you need our specific approval for. You can't just start spending money on things that we haven't approved. Those are called protective provisions. There's a lot of different ways to negotiate, even a Dragon's Den deal. And as you go further down the cap table, say Series A, Series B, Series C, those in the U.S. Type system, those deal docs can be like 6-7 different agreements with a total page count of 120 to 150 pages. That's for real.
Wow.
In the European context, I think they keep things a little bit simpler. There's differences between common law and continental law, not worth getting into here. But so in any event, what I'm saying is, everything is deal specific depending on what kind of deal you're doing. But even with, say, Dragon's Den or Shark Tank, it's never that simple.
Wow. So this is why it's really important to make sure you find out, and educate yourself, so you don't end up getting rejected and not understanding why you got rejected, right?
Yeah, you need to understand the rules of the road. I mean, that's part of the education process. And so that's what we've done at ARRI. We've created a series of venture finance masterclasses that kind of take you through it, and you can spend your Saturday morning eating Cheerios and learning about venture finance.
So Brad, it's been a fantastic insight. We've completed the educational stage of the fundraising roadmap. So we've covered that it's very important for you to educate yourself on the fundamentals of venture finance. We've also covered the fact that it's really important to understand what your options are when it comes to different funding sources for your business. And lastly, on the educational stage, we've looked at deal structures, potential deal structures with different types of investors. So now I think it's time to move to the next stage, which is the preparation stage.